Right now, thousands of young Australians are, well, they're actively sabotaging their chances of buying a home, like
Yeah.
shrinking their mortgage approvals by tens of thousands of dollars. And they're completely unaware of the damage they're actually doing.
Yeah, it's incredibly common.
And the craziest part, I think, is that they are doing it because they're following the most popular mainstream financial advice on the internet. So, welcome to today's deep dive. We have a highly personalized mission for you today. We are going to save your future mortgage from terrible cross-border internet financial advice.
It's a vital intervention, really, because today we are breaking down the architectural differences between the credit systems in Australia and the United States, and we're untangling this massive myth that is doing real, tangible harm to people's bottom lines.
Okay, let's unpack this, because we all know the formula of the American finfluencer space.
Yeah.
Right? You open your feed and it's just a barrage of, Dave Ramsey talking about debt snowballing, or Caleb Hammer yelling at guests about their takeout spending.
Right, the high emotion content.
Exactly. And there's this hyper-focus on hacking your FICO score. It is super engaging. But for an Australian listener, applying that US-centric credit-building logic is actually a massive trap.
It is functionally disastrous. And, the issue really begins with a sheer lack of local, high-quality alternatives. Nature abhors a vacuum, right? And in Australia, there is a massive vacuum when it comes to financial advice on social media.
Yeah.
And it isn't because Australians don't care about personal finance. It is entirely regulatory. Australia has incredibly strict frameworks governed by the Australian Securities and Investments Commission.
Right.
Exactly. You cannot just, set up a ring light in your Sydney apartment and start telling people what to do with their money or how to structure their debt. If you do that without being a licensed financial advisor, you are risking severe legal penalties.
Which creates a really fascinating dynamic, because you have young Australians who, genuinely want to be financially responsible. They're looking for guidance, but the local environment is so restricted.
Yeah, it's mostly dominated by highly regulated, dry institutional content. Or on the flip side, property gurus trying to funnel you into a $5,000 seminar.
Right. So naturally, they turn to the endless, highly produced buffet of U.S. content. It's like studying for a chemistry exam using a physics textbook. I mean, sure, it's all science, but you're still going to fail the test.
That is a perfect analogy.
But I have to ask, is the advice from these U.S. creators actually bad? Or is it just, lost in translation?
Well, they consume it, they internalize the rules of the American financial game, and then they try to execute those plays on an Australian field. And when we look at the comparative analysis of the lending mechanics, the advice completely breaks down.
Wow.
I mean, telling someone to budget and save is universal, but the moment we cross into the mechanics of credit and borrowing, it is an entirely different universe.
And the absolute pinnacle of that U.S. advice, like the golden rule that every single creator pushes, is getting a credit card specifically to build your credit score.
Yeah.
That is the trap door. So how does the logic of that work in the American system fundamentally? Why are they so obsessed with the credit card?
Because the American credit system, it operates very much like a loyalty punch card for debt.
Yeah.
Lenders in the U.S. assess creditworthiness by looking at your historical track record of managing borrowed money.
Okay.
They specifically look at a metric called your credit utilization ratio. So if you are an American and you take out a credit card with a $10,000 limit and you only spend, say, $1,000 on it.
Keeping your utilization low.
Exactly. You keep it low and you never miss a payment. You are generating positive data points. The algorithm sees that you have access to capital, but you use it responsibly and you pay it back.
Right.
By successfully juggling that debt, you prove your reliability. That increases your score and makes banks eager to lend you more for a mortgage.
So you are basically building a trophy case of paid-off debts. You point to the case and say, look at how good I am at borrowing.
That's a great way to put it.
But the architectural difference here is staggering. In Australia, the banks are not looking at your trophy case. They're looking at your maximum borrowing capacity.
And this is the fundamental disconnect that ruins people's mortgage applications. In Australia, successfully managing a credit card does not make you a more attractive borrower. It makes you a liability.
Wait, what if I get a credit card right now just for emergencies and the balance is just sitting at zero? I haven't bought a single coffee on it. Doesn't that prove incredible discipline?
You would think so.
Yeah. Why wouldn't a bank in Melbourne or Brisbane reward that behavior?
Because Australian lending regulations aren't built to reward past discipline. They are built to stress test your absolute worst-case scenario future.
Oh, wow.
Yeah. Following the Royal Commission into Banking, Australia reinforced very strict responsible lending obligations. Legally, an Australian bank cannot put you into a loan that would cause you substantial financial hardship.
Because if they do, the bank is liable.
Therefore, when they assess you, they must look at your maximum exposure to debt.
Ah, so it isn't about what you have done. It is about what you could do.
Precisely. If you have a credit card with a $10,000 limit, the bank's underwriter has to assume a scenario where you lose your mind tomorrow, max out that card on a holiday to Bali, and suddenly have to service $10,000 of debt.
At like a 22% interest rate.
Exactly. On top of your new mortgage, they mathematically have to factor that potential monthly repayment into your budget.
The data on how this translates to a mortgage application is just brutal. Like, say, an Australian bank evaluates your income and determines they can lend you a maximum of $500,000 for a house.
Okay.
Then they run your file, and they see that $10,000 limit credit card sitting in your wallet.
Simply because the facility exists, your maximum borrowing capacity drops.
Duh.
Dollar for dollar, and honestly, sometimes even more, depending on the bank's internal buffer rates. That credit limit eats into your mortgage,
So your capacity drops instantly to $490,000.
even if the card has never been used.
Wait, really? Even if you literally cut it up and threw it in the bin, but never officially closed the account?
It does not matter. The limit exists, therefore the legal liability exists, therefore your borrowing capacity shrinks. If we connect this to the bigger picture, you can see the tragedy unfolding here.
Yeah.
You have thousands of young Australians earnestly trying to set themselves up for homeownership. They watch an American YouTube video telling them to open a card to build their score.
Right.
They get the card, they meticulously pay it off every month, thinking they're doing everything right, and then they walk into a mortgage broker's office, only to find out they've actively sabotaged their ability to qualify for the house they want by tens of thousands of dollars.
They literally shrunk their house to build a score that the bank doesn't even value. I mean, that is maddening.
It is.
So if Australian banks are effectively penalizing access to credit, and they don't want to see a history of managed debt, how do they actually model your reliability? Like, what is the metric they use to decide if you are a safe bet?
The central metric is your free cash flow. They want to see what your daily financial diet looks like,
The daily financial diet, I like that.
rather than the trophy case of debt.
Exactly. So instead of looking backward at a FICO score, Australian lenders put your current bank statements under a microscope. Usually it's a strict 90-day audit of your transactional behavior.
Okay.
They calculate what is called your serviceability. They want to know, mathematically, if you have enough excess cash left over from your income every single month to easily cover the new mortgage payment.
And it isn't just taking your word for it, right? I mean, they don't just look at your salary and your rent and call it a day.
Not at all.
Yeah.
With the advent of open banking, the algorithms physically scrape your transaction history.
Yeah.
They categorize your spending.
Oh, wow.
Yeah. They separate your non-discretionary spending. So groceries, utilities, fuel from your discretionary spending like Uber Eats, streaming subscriptions, nights out.
Right.
And they compare your stated living expenses against a benchmark called the Household Expenditure Measure, or HEM. So if you claim you only spend $2,000 a month to live,
But the HAP benchmark for your demographic says it should be 3,000. The bank will often use the higher number to calculate your cash flow.
got it. So keeping your actual daily expenses low and maintaining consistent, boring savings is the real Aussie version of building credit.
It is the absolute core of the system. A bank will vastly prefer lending to someone who has never had a loan in their life, but who consistently saves 20% of their income and keeps living expenses low.
Over someone who has like perfectly managed 3 different credit cards but lives paycheck to paycheck.
Exactly.
But what about smaller commitments? The source text points to postpaid mobile phone plans as one of the few ways to demonstrate this kind of serviceability without taking out a traditional loan.
Yeah, a postpaid utility or phone bill is a fantastic data point for an Australian underwriter. It isn't a debt in the traditional sense, but it is an ongoing financial commitment. Having a postpaid phone plan and paying it reliably every month proves that you can manage a recurring non-negotiable expense. It establishes a baseline of financial maturity without introducing the high-interest liability of a revolving credit card.
But of course, because they are auditing your daily financial diet so closely, missing that phone bill payment is going to stick out like a sore thumb.
It will. And, that brings us to the other side of this microscope, because if keeping expenses low is the green flag, there are massive glowing red flags that Australian banks actively hunt for during that 90-day bank statement audit.
And the biggest one right now, which the text highlights as causing huge issues for young borrowers, is online gambling.
Yes. This cannot be overstated. If you are preparing to apply for a home loan in Australia, transferring money into an online betting app is a critical error.
Even if it's just like $50 here or $100 there for a weekend sports bet.
Yeah, but why are they so draconian about it? Like, if I make 100 grand a year and I throw 50 bucks on a footy game, the bank obviously knows I can still afford the mortgage. Why does that tiny transaction matter so much?
Because it isn't about the $50. It is about behavioral risk and predictive modeling.
Okay.
When an underwriter, or increasingly an AI sorting algorithm, looks at your bank statements and flags a pattern of online gambling, they're assessing your impulse control.
Huh.
A mortgage is a 30-year commitment built on predictability.
Right, they want stability.
Exactly. A habit of gambling suggests a volatility in your discretionary spending. It tells the bank that your cash flow is susceptible to sudden irrational drains.
So it breaks the model.
It completely breaks the model. Lenders look at gambling and see a risk profile that could spiral if the borrower experiences stress, say, an interest rate hike or a job loss.
Yeah, that makes sense. Many banks will outright reject an application, or at the very least force you to explain yourself to a human underwriter if they see active gambling accounts on your transaction history in the months leading up to the application.
So if cash flow is king and avoiding gambling apps is what gets you the house, it completely upends the entire purpose of a credit score. I mean, do Australian credit scores even matter at all, or are they a total myth?
Well, they do exist. Australia uses comprehensive credit reporting, and you do have a score through agencies like Equifax or Experian, but it serves a completely different function than it does in America.
How so?
In Australia, a credit score is almost exclusively a negative filter. It is a risk assessment tool used to limit liability. It is not a positive ladder you climb to unlock better lives.
Meaning a great score doesn't get you much, but a bad score ruins you.
Precisely. Having a perfectly average credit score in Australia won't stop you from getting the best mortgage rate on the market, provided your 90-day cash flow audit is pristine. The bank checks the score simply to ensure you don't have any hidden defaults, bankruptcies, or a history of deeply delinquent payments. It exists to catch the people who have actively failed to meet their obligations. It is a pass-fail mechanism, essentially.
Here's where it gets really interesting, though. When you contrast that negative filter with how the U.S. system operates, the American credit score is terrifying.
What's fascinating here is how deeply the FICO score permeates everyday American life, far beyond just the walls of a bank.
Yeah.
Through a combination of historical corporate lobbying and, frankly, a lack of restrictive privacy laws regarding financial data, the U.S. credit score has evolved into something much more pervasive. It functions almost like a quasi-social ranking system.
The breakdown of the U.S. system shows that your FICO score dictates job applications. It dictates whether a landlord will rent an apartment to you. It even impacts how much you pay for car insurance.
Oh, it's everywhere.
Yeah, handing an employer your credit score is like handing them a permanent record of every late utility bill you've ever had.
It is a profound difference in cultural and structural philosophy. In the U.S., the FICO score has become a proxy for moral character and general responsibility.
Wow.
Financial mistakes from your youth, a missed car payment in college, a medical bill that went to collections, they can haunt your score for up to 7 years.
That's a long time to pay for one mistake.
It is. And because employers and landlords heavily rely on this single numerical metric as a gatekeeping tool, people with poor credit can find themselves functionally locked out of society. They are denied the best jobs, they cannot rent in safe neighborhoods, and they pay wildly inflated premiums for basic services.
It creates a self-fulfilling cycle of poverty. If you have a low score, you can't get the good job to make the money to pay off the debt to raise the score.
Exactly.
But in Australia, because of privacy laws and employment regulations, that simply does not happen. You do not bring your Equifax score to a job interview in Brisbane.
No, absolutely not.
The landlord checking your rental application is looking at your pay slips and your rental ledger, not doing a hard pull on your credit file to see if you paid your electricity bill late 3 years ago.
Correct. In Australia, the scope of the credit score's power is strictly firewalled. It is limited to financial institutions assessing direct lending risk. It does not bleed over into employment or basic housing in the systemic, punitive way it does in the United States.
So what does this all mean for you listening right now?
Yeah.
If you are preparing for a mortgage or honestly just trying to navigate your personal finances in Australia without stepping on a hidden landmine, your first and most important job is to ruthlessly filter the media you consume.
Absolutely.
You have to recognize that a brilliant U.S. financial hack might be a devastating Australian financial trap.
You need to understand the architecture of the field you are playing on.
Exactly. Protect your cash flow. Put your energy into maintaining a clean, predictable 90-day bank statement. Pay your phone bill on time to prove your serviceability.
And step completely away from the online betting apps if you want a bank to take you seriously.
Yeah. And whatever you do not go opening a $10,000 credit card just because a very entertaining guy on YouTube told you it was the secret to building wealth. You are just shrinking your borrowing capacity.
It all comes down to where the microscope is pointed. But, looking at the trajectory of the Australian system raises a broader, incredibly important question.
Oh.
Well, we know Australian lenders are ignoring traditional credit building in favor of scraping your raw transaction data. They are scrutinizing your daily financial diet, right?
Right.
Judging your online gambling, categorizing your Uber Eats spending, calculating your exact discretionary lifestyle to determine your free cash flow.
They're essentially doing a behavioral audit.
Yes. So, are we quietly moving toward a future where our raw bank statements act as a highly intrusive, unregulated behavioral score?
Oh, wow.
I mean, in America, your financial past is boiled down to a blunt, standardized 3-digit number. It is flawed, but it is transparent. In Australia, you're subjected to an algorithmic judgment of your daily lifestyle choices.
That's a huge shift.
Is having a bank's AI silently judge your weekly coffee and pub habits to decide if you deserve a house actually any better or any less invasive than the American social ranking system?
Wow. That is a heavy thought to chew on.
Yeah.
Is the Australian financial diet audit just a more sophisticated, invasive version of the American social ranking disguised as consumer protection? We will leave you to ponder that one. Thank you so much for joining us on this deep dive. We hope you feel a lot more equipped to cut through the financial noise on your feed. Remember, check the rules of the system you are actually living in, protect your cash flow, and keep questioning the advice you consume. We'll catch you on the next one.